Hey everybody, this is Scott Hudspeth with Agent Mastermind. So awesome to have you guys here. Honored to be a part of your lives. And we have Vern, a great dear friend of mine, who is actually my CPA now, that is back on the call. We've done a couple calls with Vern out of California, and he has given me so much advice and good advice that I decided to go with him. So you're hearing it from my CPA. We just partnered up, and Vern, I can't thank you enough for all you're doing for me and all the stuff that we've done just already, and we're not even like halfway done with QuickBooks and all the strategies that we've talked about that you're going to share with us today. So I sincerely appreciate, one, you being here, and two is I appreciate your what you're doing for me and my family. So what do you got for us, man?
Absolutely. Thank you so much for letting me share some information with everybody. I mean, really what it's about is we always talk about, gosh, how do you keep more of the money that we make? That's cliche kind of. It's not what you make, it's what you keep. But it's so true.
Absolutely.
Too.
Yeah, it is, 200%.
Yeah, I think it's just so important to discuss that. And as a tax strategist, I mean, that's one of my strategies is to how do we help you keep all that you make? Well, not quite all.
Right on.
Let's see if I can get my...
Hey, if you figure that out, man, hey, I want to be first to know. If you figure that out, keep it on.
I don't think it happens legally, so it's not something we're going to talk about. But just to share a little bit about who I am, I'm a tax strategist and CPA. I've worked with small businesses for over 20 years. I started this when I was in college. I was working for CPA firms, and so I got a lot of experience working for different firms and then running my own firm as well. And I always went towards small businesses because they're the people I can help the most. And it really came special to me. In my very first CPA firm that I worked for, I was sitting in the meeting with the partner, and these clients had come in and they had a small business, and they owed like 10 grand in tax. And some people could think, oh gosh, that's not much, but for them it was a lot. They were thinking it was going to be like 1,500. And he was just saying, wow, I don't think there's anything we can do. What else can we do? You gave me this information, and I filled out the tax form. And that's when I realized that's really where the separation was. It was they gave him the information, he filled out a form, and that's what the result came out to. I realized, look, anybody can do that, right? Anybody can fill out a form. So really what it came down to was the planning, and the more and more we started in a conversation, and I started asking some questions and he asked some more questions, we realized there's all these things that they were doing in their business that they didn't know they could deduct and that he never really brought up. So we ended up going back and reworking their tax return. We saved them almost $7,500. So if you think about that,
I mean,
that's
huge.
Huge.
Huge. Unbelievable.
Yeah, it gave me a passion to say, okay, look, small businesses need help. They're the lifeblood of the American economy. They're the lifeblood of so much that we do. It's kind of our culture of capitalism. And I'm a small business owner. Scott, you're a small business owner. And everybody, I think, on this call is a small business owner, and we need help the most. We pay typically the highest amount in taxes. So that's really what made me more of a tax strategist as well as a CPA. I've also had a nationally syndicated talk show, radio show. It was called Your Practical Advisor. I did that for about a year. It was awesome. We were on like 50 stations, and I was able to share some of this advice nationwide, which was fun. And I've written a couple of books. Living a Limitless Life was my first one, and my most recent that applies to this is, hey, keep your money, exactly what we're talking about today, how to save $5,000 to $50,000 in income taxes. So the reason I share that with you is it's not about me. This could be about you. I want to show you how you can create strategies to do exactly what that book title says.
Awesome.
And Scott, I always give this to your people. If you want a copy of the book, I'll give it to you free. I'll give you an electronic copy. Just email me at neckercpa@gmail.com, neckercpa@gmail.com. I'll shoot you out a free copy of the book, and we'll get started now, though. I'm going to talk about 2 core strategies today. And out of those core strategies, though, there's so many little nuggets that you can apply to you. Now, everything might not apply to you. A lot of it probably will. Some of it you may have heard before. Some of it you may not have heard before. So really stay tuned to the information, because each of these nuggets can save you several $1,000s each. We're going to talk about the 2 main things, and that's current year tax planning. I mean, what can I do in 2015 to save money right now? And we have just gone through this process with most of our clients, and we still have a few more to do. It's never too late to start planning, okay? You can start,
well, including me. Yeah, including me. Like we come up with a great idea to help me for 2015, and we're almost done with it. So don't think that it's too late to go back and go, okay, how do I fix 15 if you're in a bind or want to keep some of your money like we started out with from the very beginning.
Yeah, exactly. And we just did that a couple of weeks ago. So it's, again, never too late. The more flexibility you have the earlier you start, it's never too late. And then second core strategy we're going to talk about is some long-term planning, because one thing as a CPA, it's easy for me to say, okay, here's how I can save you money this year. But the reality is if those strategies don't fit with your long-term plan, it's just not sustainable. And a lot of people just plan for this current year. What's this year look like? Most CPAs don't even plan, like the illustration I shared earlier. But the ones that do plan, a lot of them are focused on this year. But what if I did something this year, not knowing your goals, and 5, 10, 15, 20 years from now you have huge taxes that maybe could have been planned for and controlled if we had done something now. So we're going to touch on both of those. So my big question is it better to pay taxes now or later? And the answer is
yes.
Neither.
Neither, right? That's a good. There you go.
I wish we didn't have to pay it all now. It's our duty, we have to pay our fair share, quote unquote. But there's even Supreme Court justices who have said, look, there is no reason that the American people cannot structure their income taxes to pay the very least amount that's due under the law. And I think that's where we land, is we want to say, okay, under the law and according to your long-term goals, how do we do that? So the reason I'm so focused on saving people in taxes, it's one way to create that marginal growth. Okay, wealth is created in the margins. You've heard that before. Whether it's making an extra $500 or $1,000 on a deal, or saving an extra $5,000 or $50,000 on your taxes in a year, that incremental wealth is what creates long-term sustained wealth. So we're going to talk a lot about that today. So let's talk about current year tax planning. So why is it so important? And not only saving money, but this is crazy. This is stat right from the IRS. Americans on a whole overpay their taxes by over $1 billion every year. I mean, that's a huge number, right?
Huge number. Unbelievable. Unbelievable.
60%.
That's just sad.
It's so sad. And 60% of the returns are actually filed by tax preparers. So a huge portion of those too could have been done better. And this comes from the IRS. They're not giving us that money back. So it's really our job to say, hey, what can we do? And so I'm going to talk about some strategies for this year. And a lot of it comes down to often missed deductions. A lot of people say, oh, I can deduct this or I can deduct that. Here's what it comes down to as a business owner. The main difference between a business owner and an employee is that an employee gets paid on a W-2, all their taxes are withheld, and then they live their life on what's left over, okay? The advantage of a business owner is the fact that you make your money, you live your life, and then you pay tax on what's left. So when it comes down to what can I deduct, if it looks, feels, smells like business and it's justifiable, obviously there's things under the code that are limited, but for the most part, that's the rule of thumb I give my clients. I tell them I'll rein you in when I need to rein you in. You need to think about everything as a business, and especially real estate professionals. They don't go anywhere in the world, quite frankly, without checking out real estate. So a lot of times we miss a lot of those deductions if you don't think about those. So let's talk about a few of them. The home office deduction, and this is huge. When I first got into this industry, it was like taboo 20 years ago to take a home office deduction. There was this big lawsuit by the IRS against a doctor named Solomon, and all this case law that basically said he was just abusing this rule. And so most CPAs just said, no way am I taking that home office deduction. Now I'll tell you today, there's no taboo with it. Now there is a right way and a wrong way to do it. I think I've done it right because over the last 20 years I have never had any IRS examination, look at a home office deduction, okay? And I've only had 2 examinations. We call IRS examinations, you'd call them an audit, is kind of the street lingo for that. I've only had 2 audits in my entire career. So the home office deduction is valid, and the way you take it is, it's basically based on square feet. So if you have a 3,000 square foot home and 300 feet is office space, then that's pretty straightforward. 10% you get to deduct. So what can you deduct? Really, again, it goes back to looks, feels, smells like business, but now these are things that normally wouldn't be deductible. Your home personal utilities, your gardener if you have one, repairs, maintenance. Some people take depreciation. Typically, I don't, and the reason we don't take depreciation is because then you have to recapture that when you sell your home, and it doesn't all fall under that nice home sale exclusion of $250,000 for single individuals and $500,000 for married people. So you have to recapture some of that. So I typically don't take depreciation. There are cases where I do, but really anything that can be based on that office, you can deduct. If you remodel that office, that remodel is deductible, okay? But here's, especially for real estate professionals, here's the power of the home office deduction. It's not necessarily just these things I've listed here. These will probably save you somewhere between $1,000 and $5,000 a year in taxes, depending on the size of your home and your amounts for these items. Where it really comes into play, though, is real estate professionals drive a lot. They put a lot of miles on. And according to the tax code, driving from your home to your office does not count as business. Okay, so that's personal commuting miles, which cannot be deducted. Driving between office and office is 100% deductible. So these may only save you a few $1,000s a year, which is a lot of money. Don't get me wrong. I talk like it's nothing, but I'm going to show you some really cool strategies later to save you more. But we see typically real estate professionals especially, which I focus a lot of my practice on, they increase their business vehicle use deductions by sometimes as much as 25%. So that's a huge number. Then business travel, that's another one, okay? I don't know any real estate professional, or quite frankly most business owners, that don't go somewhere on business or don't go somewhere, maybe they say it's personal, to visit Aunt Ann or whoever it is, that you don't look at real estate or you don't look at competitors and see what they're doing in that location. So a lot of people don't take all of the business travel deductions that they can take. And those include, all your airfare, your mileage if you're driving, your lodging, your meals. Foreign travel can sometimes be deducted. Everybody always asks me, how do I get to deduct my trip to the British Virgin Islands, or do I get to deduct my trip to Mexico? And when we start traveling foreign, we have to really look at what the business purpose of that trip is. So a lot of times though, people take a cruise, business cruise or something like that with partners, with clients, all of that's deductible. So you really need to focus. One thing on business travel, if you're going to be someplace over a weekend, maybe you just want to go to Vegas for the weekend or wherever it is. If you have to work there on Monday and you go Friday and your airfare is cheaper because you're flying on those days, then now that whole trip can be deductible. Those extra 2 days in the middle can be deductible. So a lot of CPAs.
So what you're saying is I need to find somebody on the cruise that I'm going to be on that has to do with business, so I can write this trip off.
Absolutely, right. So
and have a drink with it. Business. Yeah.
They have singles cruises, and people go there and prospect on singles cruises, but they also have a lot of business cruises, right? I've spoken.
What if I just stand up in the middle of the pool area and start presenting? Did that classify or?
Gosh, for you, Scott, it probably would, because I think you have.
Okay. All right.
You can prospect, and if you can say, hey, part of this trip's pleasure, part of it's business. Maybe you don't deduct 100% of your trip, but you can sure deduct part of it, especially if you can justify that. So a lot of associations put together trips like that. I know internet marketers do it a lot. I'm sure there's some real estate ones out there. There's a lot of different industries promote that because the cruise industry does that. And whether you like cruises or not, that's fine. But they also have seminars overseas and things like that. So certain trips like that, be careful with the foreign travel, but also don't not take it because your CPA said, oh, no, that's personal. Surely you didn't do any business there. Okay? So don't miss that deduction. That can literally be thousands and thousands and thousands of dollars of tax savings every single year. Now let me qualify that real quick since I'm talking about it. I have a lot of clients who say, oh, well, you said I could deduct this, so I made $100,000 last year and I had $50,000 worth of meals and entertainment. That's when it's my job to kind of pull the reins in and say, okay, that's probably not reasonable for you, your income level, or your industry. Now some people, you know, it just depends on what the industry is. So we have to remember taxes are a very, very personal thing. And so your situation is probably different than the next guy. So you have to really be careful about saying, oh, Joe does this, so I can do this. You just have to really think about, hey, this is personal to you. That's why a tax strategy should be personal to you. HSA plans, this is something that's evolved over the years. It stands for Health Savings Account Plan, and it used to be just for self-employed, and then it was for self-employed and employees, and then it depended on the plan, and then you know some of them you couldn't get your money back out, and HSA plans you can. They've really honed this in. So the thing about an HSA plan is it's pre-tax. So if you can pay for things you're going to have to pay for anyway, and you can do that before you pay taxes on that money, it saves you typically about 40%. So, I mean, that's a huge savings. So with an HSA plan, go through some details, but you have to have qualified insurance, and that means everybody's not going to qualify, but typically it's a higher deductible. It's an HSA qualified plan. But for a family, you can put away $6,500 a year. So if you think about, gosh, what's the buying power of $6,500 a year? It's not a huge tax savings, but it's like spending over $9,000. You know, I can pay for orthodontics, dentist, all your out-of-pocket type medical that normally wouldn't be covered. So it's not huge, but it is, right? Wealth is made in the margins.
Yeah, right.
$3,000. So you have to think about that and say, okay, so if that's the kind of insurance plan that I want, and that works for me, then this is a strategy that's often overlooked. Now, the thing about an HSA, if you do have a qualified plan, you can actually set that HSA up now. You can put that money in there now and get the deduction for this year, okay? And you can actually make some of those contributions next year and have it applied back to this year. So that's one of those things that if you have the plan set up, you can actually take some benefit for that even after the end of the year. So if your plan's qualified and you want to save some money, you know you have medical expenses out of pocket that you're going to end up being paying. I have 2 kids in braces, so this plan works great for me.
Yeah, right, exactly.
So you always have to think about those little things about what's going on in your life. And then we'll talk about retirement plans. So there's a lot of different kinds of retirement plans, but the main difference between all of them is there's before tax and there's after tax. So some retirement plans you get a tax deduction for now, and you're taxed on those funds when you withdraw them. And then the after tax ones are where you don't get a tax deduction for them now, but you're not taxed on them in the future either. So it's kind of the best of both worlds. There's basically 3 ways here. I'm going to talk about this because this ties into the retirement plans. There's 3 ways that you can invest your money from a tax perspective. There's tax today. Sometimes I call that tax always. There's tax tomorrow, and then there's tax never, which, okay, look, it's not quite true, but it's as close to being true as it possibly can. So tax today, these all have advantages and disadvantages. Everybody says, hey, what's better for me? What bucket should I have my stuff in? And the answer is it depends, and the answer is probably maybe all of them. Tax today is that money that you put $10,000 in a savings account, and although we don't make any money on those anymore, that's after-tax dollars that go in there, and then every time you earn interest on that, that interest is taxed. So you're always being taxed on that money. Now the advantages to that are that it's easily accessible. Boom, you got it today. If you need it, you can liquidate those investments, whether they're mutual funds, money market, cash in savings, whatever it is. You can have that today. The disadvantage is, well, it's taxed all the time. Uncle Sam's constantly giving you a haircut on that income. Tax tomorrow or tax later, that's your typical 401k plan, your traditional IRA, and then tax never is like a Roth or a 7702, and I'll go through these in more detail in a second. Tax tomorrow or tax later, I want you to think about this. It's like the farmer who has his seeds and he's getting ready to go plant them in the ground and they're going to create a bountiful harvest. Tax later or tax tomorrow, Uncle Sam basically says, look, I'm giving you the seeds for free. You can have those seeds. Go plant them. Let them grow into this great bountiful harvest. I want my piece of the harvest. And then the tax never or tax later bucket, or tax never bucket rather, it's like saying, okay, I'm going to tax you on all your seeds. All the seeds that you're going to plant, I'm going to tax you on those, but you get the harvest for free. Okay, that's a powerful analogy for me to look at this and say, okay, I get that, right? So what are those? These are the most familiar retirement plans. You got your traditional IRA, your Roth IRA, your Simple, your SEP, and Keogh. Keoghs are an older plan. 401k, then there's a Roth 401k, solo 401k. I mean, there's all these different kinds. So the tax later bucket are your traditional IRAs, your simple SEPs, your traditional 401ks, and your solo 401ks. The Roth 401k and the Roth IRA, those are tax never, right? So you don't pay, you pay tax on the seeds that you put in, but you gross tax-free and you pull it out tax-free. So there's a lot of power to that. Now, which one should you be in? It depends on what we want to do, right? The challenge is that most people fill that tax later bucket first, and they want to fill it bucket by bucket instead of doing maybe all three.
So it's full, till it's full, like fill the first one until, like, I can put in, what is it, $52,000 a year in the one IRA, depending on what program you have. But after that, then they fill that first, then they fill something else. Is that what you're saying?
Exactly, right? Or sometimes, they only have $25,000 to put away, so they just say, hey, I'm going to put it all in this tax savings one.
Okay, got it.
Rather than say, hey, maybe I should split them. So the right answer may be that. We don't know because we don't know what your long-term goals are yet, but when we find those out, then you structure that. The challenge we've had is we've had so many people who've done so well in that tax later bucket that they've built up $1 million or $2 million or $3 million, and now it's time to start taking it out. And the whole myth about that typically is that, oh, I'll be in a lower tax bracket when I retire. What we find with a lot of our clients is they love what they do so much that they're doing it at some other level, or they've figured it out, so making money is a lot easier to them than it was when they were in their 20s and 30s and stuff like that. So they make a lot more money for a lot less work, so they don't want to give that up, but they have to start taking that money out, and then all of a sudden it's, I want to live on $200,000 a year, and then they come to me and I say, well, you have to take out about $300,000 so you can pay the tax, and then you'll have 200 or a little over 200 to live on. And that's a totally different retirement picture if you're basing that on, I've got $1 million invested or $3 million invested, whatever that number is. So it's not so much about not doing that, it's about saying, how can I control that income? If they had done both, the tax never and the tax later, then they can say, I don't have to take as much out of my tax later bucket, so I'm going to shrink my income tax liability, and I'm going to take some of this tax-free money out of my Roth IRA or things like that to help control that income. So it works both ways. So the thing about a Roth now, a lot of people say, whoa, gosh, I make too much money to make a Roth contribution. Yeah, because you make over $160,000, boom, you can't do it anymore. So here's a secret. Maybe you know, maybe you didn't know. You can still make a Roth contribution. It just takes 2 steps instead of 1. So there's a loophole in the law. When the law first came out, it was if you make over $160,000, you cannot make a Roth contribution, and you cannot roll your traditional IRA over to a Roth. Then Uncle Sam needed some money, and they said, well, wait a minute. What if we let anybody do that rollover into a Roth IRA from their traditional and pay the tax now? What would that look like? That would give us some money. So they changed the law. What they failed to do is say that you can do this now on an ongoing basis. So if you can put $6,500 or $5,500, depending on your age, into a traditional IRA, you can immediately then roll that to a Roth, and it's just the same as making a Roth contribution. So you can do that. Okay, so that's huge. It's just 2 steps instead of 1. But if you're high income and that's worth it to you to get some money in a tax never bucket, that's something you
absolutely
can do. So
yep.
Okay, tax never. That's your Roth IRA. They have a Roth 401k now as well. And then there's something called a 7702 plan. And really what it is, it's cash value life insurance. The difference between that is the Section 7702, the IRS basically dictates what's the most amount of money I can put away to take advantage of that tax-free growth and tax-free withdrawal for the shortest or smallest amount of insurance. Typically when somebody sells you insurance, and it's got a really bad rap, I think, when they sell insurance, they want the highest amount of death benefit or death insurance, what I call it, as they possibly can, because that's how they get paid, right? The smart people, though, they say, look, I don't need to get paid as much, but if people are going to put a lot of money in here and use this to its fullest tax advantage, that's the power of some of those cash value type policies. And the 7702 is really the code section. You've heard of 401k, that's a code section 401k that outlines the parameters of those retirement plans, and the same with 7702. So it may be an option, it may not, but that's one way to do that. The thing about a 7702, there's no income limitation, so like the Roth, the 160, even though it's 2-step, but there's also no restriction on how much you put in. So on a Roth, if you're putting in $6,500, you can put, I've worked with a guy, he's created plans that people put $25,000 a year in, they put 50, 100, 200, 300. So there's really no limitation because you're creating this bucket that works for you. Now that money grows tax-free withdrawal. You also don't have the age restrictions. So your retirement accounts are 59 and a half. You have to be, if you want to take those funds out without penalty. And a 7702 you have easy access to the funds. There's no penalty. You can actually borrow it out. There's a really cool strategy. I'm not going to talk about it today, but it's really kind of self-banking, and a lot of my real estate investor clients love it because they can stick cash here and then they can borrow it out and use it for their next deal and then put it back. So really, really flexible. Does that work for you? I don't know if it does or not. So the bottom line is,
one of the questions coming in, Vern, is like, so they, when should I start thinking about, like, obviously your income needs to be more than your expenses, but at what point should I start thinking about and being able to use some of this stuff to decrease the amount of money that I give to the government and keep more of what I have coming in? What number does that really start to take effect?
Really where you start saying, okay, what should I be doing? You're obviously, like you said, you're making more than you're spending. That's strategy number one. And then you kind of go back to basic financial planning. I've got some cash in the bank, and I don't have to worry about, next month or the month after that, because that's what that tax always bucket is about, is the kind of that emergency type fund. Once those two things are in place, you should really be thinking about, okay, what do I want to accomplish long term, and what does that look like? Is that a tax later or tax never bucket? And college funding comes into play if you have kids and you want to do that kind of stuff. So really, if you're at that stage where you've got some cash put away and you're comfortable and things are cranking and you want to pay less taxes as a self-employed person, you need to start thinking about that now. The challenge is the easy solution for most CPAs is, oh, go buy a new vehicle, we'll deduct it, yada, yada, yada. And that doesn't really fit within a long-term plan. I mean, I'm all for buying a new vehicle if that's what we need to do, if it makes good business sense. But my strategy is, if it doesn't make business sense, it is just flat out stupid. I'll just say that.
Yeah, right.
Stupid to go spend $10,000 to save $4,000, and that's at a 40% tax rate. Now, if you were going to buy a vehicle or a computer or anything like that anyway, timing is perfect. Let's time it to where, hey, We do it when it's most advantageous to you, but don't just go spend money to save money on taxes. Somebody once told me that, once you have those long-term goals in place, all these little short-term decisions, they fall right into place. Should I do this retirement plan? Should I buy this? Should I do that? Should I get a different house? Should I refinance my mortgage? When you have that long-term goal in mind, it's easy. All you have to do is go look
put the number to
at that long-term goal and say, is this in alignment? If it's in alignment, do it. If it's not, don't. So this is a long-winded answer to the question, but I think it's so important to make sure.
Yeah, and so I guess more or less make sure you're talking to somebody that knows all the different ways, because I know with you and I, we went back and forth for a couple months figuring out the best way to utilize. I got kids in college. I do have 401k. I do have a SEP IRA. I don't even know what I have, but I have all these accounts. So it takes time to dissect and really truly give you, because you have to pick an option. But I want to pay less in taxes. So how do we make that happen? And so we're coming up with different ideas to make that happen. But every person on this call is going to be a little bit different. And so I think having a conversation with somebody that knows all of the different avenues and all the different strategies and all the different ways to make it better for you and your family, short-term and long-term, before tax, the after-tax bucket, the never-tax bucket, like all that stuff. You gotta look at all those in the big picture of things. Like, what do you want to accomplish?
Exactly, because these are all tools. So it's just, how do we get to where we're going? What tool do I pull out of the toolbox? And not that plan doesn't change. Once that plan's in place, you tweak it. You don't have to overhaul it, so to speak. So I'm going to talk about some long-term stuff, and I think this is kind of the foundation of where a lot of small business owners need. And I call it the C Corp strategy, and this may or may not work for you, but there's going to be some things that we're talking about, because really there's three phases kind of to business. And there's that first stage. Well, I'm just going to go through them one by one. What most people do is they just say, boom, I'm going to set up a sole proprietorship. And they just go into business, right? It's easy, right? That's why they do it. There's no entity to set up or anything like that. Sometimes you have licenses, whatever. But the reason it's easy is because you typically pay the highest taxes. Okay. The second thing is there's really no liability protection. Now, some people have insurance that can cover that, but liability protection in today's society, I think, is paramount to having some of that. The other thing about a sole proprietorship is they are the highest audited return there is. It's a schedule.
Really? Okay.
And it's just the way it's been for a while, and it is what it is. So sometimes, and not saying you're doing anything that you shouldn't be doing, they just get looked at more than entities do, and it is what it is. But it's one of those things I think you need to really focus on. Should I really be there or not? Even if it wasn't huge tax savings to change, is that where I really need to be? So I'm going to walk through the tax side of a sole proprietorship. And a sole proprietorship is basically a Schedule C on your federal income tax return. I'm going to use general numbers just because I don't know your situation. I'm going to use like a standard deduction instead of itemized deductions, things like that, just to kind of give you a basis. The whole object of this is to say, okay, comparing phase 1 to phase 2 to phase 3 is how I call it. In your business. So if you had $300,000 worth of income, and I put everything in a bucket, my bucket is like a legal entity. So your sole proprietorship, $300,000 in income. You pay self-employment tax on the first $118,000, the Social Security and Medicare part. And then you also pay Medicare tax on the rest of it, okay? So it becomes a big number when you look at just that piece.
Yeah.
So the self-employment taxes alone on that are about $19,700. And really the tax savings going to a S-Corp, which I'll talk about here in a minute, really is focused on saving a piece of that number. Again, I'm using a standard deduction, married, 2.2 kids, the whole 9 yards, just kind of averaging this out. You have about $22,000 worth of deductions. So you're paying tax on $278,000. That's your taxable income. The income tax on that, $65,700. And you add the SE tax to that of $19,700, boom, we're paying $85,000 $400 in tax on $300,000 worth of bottom line income. So you might make more than this, you might make less than that. It doesn't really matter. What does matter is that you just kind of get this concept to say, okay, where do I need to be? When does it make sense, which we can talk about in a little bit, to maybe switch out of this sole proprietorship. Now, some of you, I call this phase one. It's a lot of tax. You pay a lot of SE tax, and I don't know how your feeling is about Social Security, but sooner or later it's not going to be there. That's all.
Is that the truth? Is that the whole truth and nothing but the truth? Yeah.
According to me.
Oh boy. Oh boy. Okay.
So then everybody says, so what do I do? Should I set up an LLC, a limited liability company? An LLC gives you liability protection. I love them. Okay, that's the one main reason I really like them. The thing you got to be careful about, though, is you get no tax savings unless you do what. Here's why I really love LLC. This is my favorite entity if it's done right, and I'll just say that. It has to be done right, because number two can come back and bite you if you don't do this. An LLC can be taxed as a sole proprietorship, it can be taxed as an S Corp, it can be taxed as a C Corp, it can be taxed as a partnership, which we're really not going to talk about the partnership stuff today. So it's very, very flexible. So it's my favorite entity when used properly. A lot of people, as a matter of fact, I had a client who came to me and said, I set up an LLC, I should have all these tax savings. And unfortunately, they didn't do anything else. They didn't do anything with number three as far as how do we want to be taxed. Luckily, we were able to retroactively go back and change that to an S Corp for the prior year, and it saved them about $20,000 in taxes, which was awesome for them. The challenge is some people find that out too late. So if you have an LLC, be sure you know what your strategy is about having it taxed. So I just want you to remember that we can tax it anyway. So when I say S Corp or when I say C Corp or I say sole proprietorship, they can all be LLCs too. Okay. So the S Corp, this is what a lot of people do. You get to save some self-employment tax. The main reason I like S Corps is you get some tax savings, but it also puts your return off of your Schedule C, which is more prone to examination or audit. Again, I would say I'm probably more proactive. That's a nice word, right, Scott?
Yeah,
than
very
most
proactive.
CPAs.
Absolutely. Absolutely.
And I've still only had 2 examinations, and I do have clients that basically just say, hey, sometimes it makes sense to have that sole proprietorship. They've never been audited.
Now, do we do the S Corp or the C Corp? Which one do we do?
We did a C for you.
C Corp. Okay, cool. All right.
Yep. So an S Corp does have liability protection. It has better liability protection if it's an LLC taxed as an S Corp. So just know that. LLCs, hands down, I think, is the best entity for liability protection. S Corps, though, lost most of their huge tax advantages. They used to be like a gift from God, right? And then Uncle Sam stepped in 1986, and even though Ronald Reagan was my favorite president, that's when we lost most of the huge tax advantages of an S Corp. But what they are today is still good, okay? We still get a lot of tax advantages. So an S Corp files its own tax return, but it doesn't pay its own tax. All that income flows through personally to the owner, and a lot of items flow through separately, like health insurance deductions and medical expenses and things like that. So I'm going to go through some of these kind of quickly, but in an S Corp, we've got $300,000 worth of income. I have to pay you the tax loss as a reasonable wage, so we're going to say $50,000. That means you've got $250,000 net from your S Corp plus your $50,000 wage, so we're still, using the same 300 number we were before. You take off those deductions we talked about before, your taxable income's $278. $65,700 in income tax. You reduced your self-employment tax to $76.50. So your total tax is $73,350. So boom, tax savings,
$12,000 savings, huge.
Not bad, right?
Unbelievable. That's $1,000 a month, man. That's $1,000 a month and we were using $300,000, right, for an income?
Exactly. Yes.
Yeah.
Yes. So I mean,
so is it safe to say? I don't know, and I don't know for somebody that made 150, would 6,000 be realistic?
It is. Typically, a lot of times we can save 50 to 60% of their self-employment earnings, depending on what they are. because the lower amount you make, the less the reasonable wage is going to be. So,
I mean, I don't know about anybody on this call, but to instantly take the same income I was making and save $1,000 a month just by doing an S corp, and then now you're going to show us a C corp, which might be even better. I don't know, but I mean, I don't know. I don't know. I can't speak for you, but that's kind of a crazy not to do it, right?
I think it's huge, right? That might be the funding you need to fund your retirement plan, whichever
Absolutely.
plan
Absolutely.
you choose. You know, it might fund your college savings, you know, whatever it is, whatever, again, is in alignment with your long-term goals. So a C Corp, typically people go through the phases. They go, boom, I'm a sole proprietor, and then boom, I want to save some SE tax, I'm going to be an S Corp, and then boom, maybe I need to save some more taxes. So let me talk about C Corps for a second. I kind of see this as phase 3. And some of my clients skip over phase 2, some don't. So the benefit of a C Corp is it pays its own tax, right? So it has its own set of brackets. And there's a lot better deductions in a C Corp than an S. So the separate bracket really is what you want to think about. The first $50,000 is only taxed at 15%, the next $25,000 at 25%, and then the next amount at 34%. So the bottom line comes out is if you're in the 39.6% tax bracket, federal, not counting state, and you can shift some of that income to 15%, it's a huge savings. So that's really the concept we're talking about.
Monstrous, yeah.
So on the left here, you'll see that's the S Corp, and here's the C Corp. Now you can also do this with sole proprietorship, but I use the two in tandem. So I rarely just say, hey, let's go set up a C Corp and run everything through it. Typically you want to be able to control the income that goes into your corporation, your C Corporation. So here we've got $200,000 worth of income, and we shifted $100,000 over into the C Corp, which is on the right. We're going to pay a wage out of both, the same $50,000, so I just split it half and half to keep the math easy. So on the left, you'll see this is your now S Corp or sole proprietorship. Boom, we're at 175 net out of your S Corp there. Taxable income's reduced to 197 because you're going to still have the $50,000 wage. Now your income tax is $42,000. Your SE tax is only the amount on the wages, just like it was with the S Corp there, $76.50. So your personal tax is just under $50,000. And then you got $100,000 worth of income in your corp. You pay out a wage, so you're at 75 net. So I walked you through the brackets before. The tax on that is $13,750. So now your total tax between your personal and your C Corp is $63,400. So that saves $22,000. Okay, so it's not necessarily going from just one to the other. It's using it in conjunction. Now, let me qualify a few things because all the CPAs who watch the replay will go, wow, you just can't do that. Well, the reality is it has to have business purpose, right? There's not a business I've dealt with that hasn't been able to split a subdivision off of their business, whether it's their marketing, whether it's purchasing their materials for contractors, whether it's purchasing parts for an auto repair shop, whatever it is. There's always something typically that you can set up as a separate business. If you look at Apple and Microsoft and all of that, they own a lot of different companies, and they've split those off, and it's really no different. They're under the same tax code that you are as an individual. So the strategy really is to shift that income to the lower tax brackets. Here's one thing you can do.
Good.
Yeah. This
now,
is something
now is the, and maybe I'm off by asking this. So this is coming in. Is the S Corp, C Corp? Is this before or after tax buckets type stuff?
You know, this
or
stuff
no,
here,
or no bucket.
It's not really a bucket, so it's a legal entity, but it's a way that we can structure and save taxes, so we'll have more money to put into those buckets. The buckets I kind of talked about, those three, the tax always, tax later, tax never, those are where you can put your money for, you know, whether it's retirement or some sort of savings or investments or whatever. Those are those three buckets. It relates to how much we can save you to do that. If you're not paying your kids and you have kids, you need to be paying them. So the first $6,200 that you pay your kids, they file their own tax return and they pay 0% tax on that. Okay, that's huge. So you just took your taxes of 30 or 40% and you shift it down to a 0% income tax bracket. Who doesn't want that, right?
Absolutely.
And a lot of times we also find clients now that are paying their parents The parents maybe are just strictly on Social Security. They can use a little
Interesting. Interesting. Okay.
And they can shift some income because they were going to give it to them anyway, but their parents can do some work for them and help them out in their business, and they can pay them. So you also have to remember, right after the 0% tax bracket, there's a 10% tax bracket. So if your kids are willing to work and you want them to work in your office, whether it's cleaning it up, whatever, there's a lot of different strategies to do this. I won't go through them all. Pay your kids, some great tax savings there. And then I'm going to touch on this, but a C corporation can have a fiscal year end. And here's where the power of that is. For example, if you have another business and you pay expenses to your C corporation in December, and your C corporation has a November 30th year end, a December 1st start date, what that effectively does, if you did that this year and that was your structure, that effectively defers paying the tax on that money that was paid to your corporation to do whatever it's doing for you for 14 months. So now we're not paying tax on that income till February of 2017. And the power of having that money at your disposal in your business to grow your wealth is huge. Time value of money. Einstein called it.
Yeah, exactly. And just if you earned a little bit of interest on it, it's more than you had if you had to get rid of it. Exactly. There's a lot of different things we can do with it. Yeah. So. Awesome.
Yeah, most businesses I know, they can use that money in their business, and if they're marketing or whatever, they're turning positive return on those marketing dollars.
Absolutely. Writing small checks to cash big checks. Absolutely.
Yeah, it's huge.
Yep.
So C Corp, real quick, better deductions, medical deductions. Some clients of mine have very high medical expenses. Medical expenses are severely limited. Inside of a C corporation, there's no 10% AGI limitation. Your medical plan can cover you as an owner and employee, and 100% deduction. Education deductions, and I put these code sections here because everybody always says their CPA says I can't do this, and so I put the code section in for the CPAs. You can pay up to $52,000 or $5,250 per year per employee. So if your kids are working for your corp, you can pay for some of their education costs. This is available not just to C Corps, but to everything, every entity. You just have to set it up. And it's called the Section 125 Cafeteria Plan. And it's really a way, like that HSA we talked about earlier, to use funds that you're going to spend anyway for certain things like daycare, things like that. You can set that up under a 125 plan in your business. And now you're paying with pre-tax dollars. It might not seem like a lot. It's huge. It can be huge. I mean, it's 40% more buying power. So,
big question coming in, Vern, and this has come up a couple times. I wanted to address it. Now, you're in California, but what states do you work with people in? Like, I know that you've had clients in, I think, every state, but maybe that's not the right answer, so I thought I would ask. What states do you have clients in, or what states can you work in if somebody wanted to work with you?
I can work in any state. So, CPA license, allows me to still prepare taxes for you no matter what state you're in. I don't have to be licensed state by state. It's not like financial advisors and realtors and things like that. So I have clients all over the country, from New York to California to Wyoming. I don't believe I have clients in every single state. I don't have clients in every single state now that I'm thinking about it, but I have clients probably over half. So.
Okay.
Also, C corporations, they don't have to be set up in your home state. If you have an online portion to your business or something like that, those can be set up in a state that's more more beneficial for taxes, so to speak, and they also have liability protection. So a lot of people say, well, why isn't everybody doing this? The myths are that they're complicated and there's double taxation. Double taxation is there if they're not used properly. So when a corporation pays out a dividend, it doesn't get a deduction. The recipient has to pick it up as income. That's the double taxation of a corporation. So you structure your payments out of your corporation so they're not dividends. It's pretty simple. C Corps aren't for everybody, though. I'll just tell you that. You have to have the right set of circumstances. Will it work for you? It could.
Is there an income limit on that? Is there an income for C Corp? Like, I should consider this at what, or is there a reason I would consider a C Corp?
I would consider it once you know you have $50,000 worth of income that you could peel off of your business. If you're living on every single dollar that you make, a C Corp strategy is probably not for you. The challenge with the C Corp is you want to be able to have some of that cash, although you can access it. You want to let that income grow in that C Corp. So that's how we get that shelter, so to speak, is of using that C Corp. So if you're spending everything you make, it's probably not strategy for you. I had a client once who was a contractor, great guy. Unfortunately, he passed away several years ago. He became a dear friend of mine, but he said, Vern, when I said, why do you have a C Corp? Because most CPAs are taught, oh, C Corps are bad. When you really study them and do the work, they're awesome. And he knew this, even though as a green CPA when I first met him, I didn't know it. He said, Vern, all I have to do is live inside my C Corp. And then we talked about that for a while, and I was like, okay, I get it. So you have to know how to use your C Corp, which we educate our clients on, but he was living in his C Corp, so to speak, and it worked for him. So if you want to implement strategies like this, a corporation, S Corp or C Corp. With a C Corp, you got to choose your state. Sometimes you can have it outside of your state, depending on your business. You file articles. You choose a fiscal year end, which is important in a C Corp strategy, and then you create your bylaws. You get a federal employer ID number, and you're off to the races, so to speak. So this strategy can save a ton of money. You just have to know if it's right for you. So
that's right. Amen.
The bottom line is these are tools. That's all I wanted to give you today was some tools. There's strategies I think that can work for your business, strategies that are flexible for you, and really strategies that give you that freedom, right? Wealth is created in the margins, and wealth gives us freedom. So that's kind of what I got, Scott.
Dude, that's awesome, dude. So here's the bottom line that my head's spinning a little bit. Even though that I work with you, I'm like, okay, man. like we've talked for like the last 2 months, and it's been exciting. Now, the other cool part you don't know about Vern is he uses QuickBooks, and dude, I can't even tell you. Like, my wife is so excited about. Like, we're going to be able to literally at the click of a button see exactly where my business is, with everything going on, with meals, with travel, with marketing expenses, everything's down to a one report, and we can see exactly where it's going, how much is going out, if it's so literally take a good look at my business, and that's what I'm most excited about. But also it allows us to put these strategies in place, knowing where everything's going, what can I maybe cut, what can I maybe increase to increase my bottom line, like all this other stuff. So I can't tell you enough how much I personally thank you. And if you guys, Vern, you have I appreciate you coming on and sharing all this stuff, and like everybody on here is a self-employed borrower for the most part that needs to fill out a tax return every year. Do you have some sort of, hey, I want to talk to Vern and see if we're a good fit type program that they could benefit from if they went with you, or maybe you could just have a consultation, and maybe it's not a good fit. I mean, obviously if we could work with everybody, we wouldn't be doing this class. So do you have anything like that somebody could take advantage of if they want to talk to you?
Yeah, so a lot of times, I'll just go through something. Okay. What I like to do is help people create their plan, whether it works for them or not. I talked with a girl yesterday, and she goes, Vern, you've talked to me for an hour. You've really helped me out in my life and in my business, and you're not even asking me to pay you. Now, most business strategists would say that's not a very good plan, but what I really want to do is I want to move you forward. And if I can move you forward, I'm going to get enough clients out of that to make a difference in their lives and in mine. So I like to help people create their plans. So here's how I do that. You basically go to save50kintax.com/strategy. Okay, I'll leave that up there too so you can see it. Okay. But really what I do is I just want to visit with people and say, okay, if I can show you how to implement some of these tools, then let me show you how to do that. Now, we may be a good fit or we may not. We don't know that yet. You don't know me and I don't know you. So what we do is we really use that call to get to know each other. And I don't have a lot of space to do this. Obviously, I could do a lot of free things all the time. And so I usually only take 17 people per month that I actually sit down and visit with, and I don't know how many people are on the webinar today, but so I have really 17 spots that I can actually fit into my schedule to say, look, let's sit down and create a plan for you. I do that basically free, okay? So here's what I do ask you to do, though. I ask you to leave a show up deposit. It's totally refundable. I don't want your money. When you go there, there's a form to fill out. You leave a $500 deposit. Now, I relate this to a lot of real estate professionals don't want to show a house until they have a qualification letter or something like that. I just want to make sure you show up. Don't waste my time. I don't want to waste yours. So just show up. And if you do that,
so mark it in your calendar. So put it in your calendar. Yeah, put it in your calendar. You put down the $500. It's a show-up fee. So if Vern gives you a plan, he's going to spend time with you. He's going to talk about your situation. He's going to give you a plan. And if you say, "Hey, Vern, thanks. Like we're not a good fit," you get your $500 back. So more or less, like it's you wouldn't want to show up to a house and have somebody not show. I wish we could do that as real estate agents. Charge somebody $100 or something so they would show up to look at the house. Right. Instead of not call and not show up, but it is this is something that's important. So that's what that is. I've never had one complaint from Vern, not one. I mean, a lot of clients I've worked with him that have been on this webinar. So I just telling you, he's a good guy. As of me, I'm using him. He's my CPA now. So just want to let you guys know that. I get nothing from this. I benefit zero. I just know he's a good guy, taking care of me and taking care of a lot of the people that have been on this class before in the past.
Well, thank you, Scott. I appreciate that. Once you leave that deposit, Carol, she's been my assistant for 15 years. She's going to call you and set up a time to meet. And we're going to get on the phone and talk. I'm going to learn more about you. You're going to learn more about me. I want to figure out your business and your goals because, like I said earlier, you need to know what your long-term strategy is so we can fit any strategies we're going to do inside of those goals. We're going to look at where you're at now so we know where you are now, where you want to go, and we're going to create a plan, a strategy that works for you on how to help get you there, a tax strategy that saves some money for you along the way and create some of that marginal wealth that we talked about. And then at the end of the phone call, there's basically three things that are going to be happening. At the end of the day, you're going to have that plan that's tailored for you that you can implement that's going to save you, I think, thousands of dollars. I've never had a call that I didn't at least save $1,000. So usually it's tens of thousands of dollars, and it gives you your freedom. And then, look, you're either going to love it and say, Vern, thank you, and you're going to say, I have a CPA, I like my CPA, I'd like him to implement it for me or her to implement it for me. I'm going to say, cool, that's fine. Take that plan, go do your best work, be the best steward that you can be, show excellence every day, here's your $500 back. We may decide we're not a good fit. That rarely happens, but sometimes I cannot help people. I've had phone calls where they just, whether they weren't quite honest or they thought they were someplace where they weren't, we just weren't a good fit, and that's okay, right? I give you your $500 back. And a lot of times people say, look, I love it. Can you help me? And I say yes. And so we implement the strategies. We do all your taxes. We talk every month. Scott just said, look, he can see every month where his bookkeeping is. Boom. We take that information, and every month we talk so we stay on track. So basically the bottom line is we just do all of this so you can focus on making money. So
all right, and what's that link? There we go. So so save 50,000 and it's right there on the screen. Save 50K in tax.com/strategy. Vern, thank you so much, man. I appreciate it. I appreciate everything you've done for me and my family, and I'm already seeing results. And it's exciting to see that my wife's not going to have to spend 2 months on taxes because it's already going to be done, with a couple minutes each month, which you have no idea. She still feels like guilty about that, so she's going to find something to do. But I know that she's going to have less to do because it's all already there in the bank account. So I appreciate you for that. Give me some time back with my wife, which is really cool. And awesome. So go to save50kintax.com/strategy. Give Vern a call. Set up an appointment with him just to see what he can do for you. And Vern, I appreciate you sharing everybody, sharing strategies. Take what you've learned here. Go meet with your tax accountant. show them the recording. To get a copy of the recording and the PowerPoint, just get with the one professional that sent you to these classes, and they're more than happy to get you those so that you can take the recording to them if you want. Have your accountant watch the recording if that helps, but or go to this link and give Vern a call. Whatever's best for you. That's what we want. So I appreciate you guys. Thanks for being part of Agent Mastermind. And again, coming up on the end of 2015. Here we go, 2016. So I hope you're ready, and I hope I just look forward to seeing some success stories. So thanks again, Vern. Happy holidays,
awesome.
My brother.
Thank you so much, Scott.
Thanks, man. Take care, everybody, and we'll see you same time, same place next week on Agent Mastermind. Have a great day, everybody. Bye-bye.